if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children were grown, the house was paid off and everything. I wouldn't worry too much about having a lot of cash around.
Would you like to earn money without doing anything? You can earn a passive income through stock dividends, which is a successful and accessible way. In this video, we'll explore hidden gems that might change your perspective on dividend investing and earning money. Did you know there is a significant difference in how rich and poor people spend their money? Wealthy people invest their money in assets that can generate income, while poor people spend their money on things that only consume money, like liabilities. For example, rich people invest in dividend stock and real estate, while poor people try to appear wealthy by buying expensive cars and houses. As Warren Buffett employs in his personal life, we strongly believe in living within your means. Investing wisely can lead to increased income and financial security. Invest in assets that generate long-term income without being overly concerned with initial costs. This is what distinguishes wealthy individuals from those who wish to appear wealthy. There are two ways to earn income from assets. The first is through appreciation, where the asset's value increases over time and you can sell it for a profit. The second is through passive income, where you earn money simply by owning the asset. For example, if you invest $100 in an asset that pays you $6 a year in passive income, congratulations on increasing your wealth and securing your financial future. Learn how to earn passive income by investing in dividend-paying stocks on the stock exchange. You can go from no passive income to earning $1,000 quickly with two ways to profit. Let's say you buy a share of Home Depot for $100, which makes you a partial company owner. If Home Depot announces the addition of new services or shops in operation, it may attract new investors who could potentially drive up the price of individual shares. Now, the share you bought for $100 is worth $300. You could profit from this by selling the share to another investor and earning the $200 difference or receiving a dividend from Home Depot. Since Home Depot is a profitable company with ample cash flow, they pay dividends to shareholders. Towards the end of each year, Home Depot can reinvest its cash into the business, save it for future investments, or distribute it to shareholders like yourself. As a shareholder, you will receive a cash dividend payment from Home Depot at the end of each quarter. This cash dividend payment is determined by how much the company has earned and how much they want to distribute to its shareholders. Currently, assuming Home Depot pays around $6 in dividends per share annually. If you own 100 shares of HD, you can expect to receive approximately $600 in dividend income each year. It may not be practical to possess a significant amount of shares. However, there are methods to increase your passive income wealth through dividends. It's important to note that not all companies offer dividends to their shareholders. Typically, larger and more established companies are more likely to offer dividend payments. At the end of the year, small companies and startups usually don't pay dividends because they need the cash to expand their operations. Paying out dividends can negatively impact their growth. Most startups have negative cash flows because they rely on investor money or debt to finance their operations. Small businesses may face difficulty paying dividends as investors may find it unreasonable considering the need for investment. Thus, if you want to invest in companies with great dividends, consider larger companies with substantial profits and years of experience in the market. Investing in real estate through REITs and high-yield ETFs can be a great way to earn passive income and grow your portfolio. By law, REITs must pay 90% of their taxable income to shareholders through dividends. If you're looking for high dividends, consider investing in ETFs like SPYD or HDV, which invest in companies with a history of offering high dividends. ETFs work like stocks, and there are many ways to verify a company's dividend payout. Firstly, you can browse various investment websites like Yahoo Finance. This can help you make informed investment decisions and find attractive dividends. To check the latest dividends paid by a company or ETF, ask Google. The information will appear at the top of your search results. Investing your money in multiple high dividend paying companies can benefit from some of the best dividends and increase your passive income.
And when we get chances to deploy the capital, we've always tried to make any entity, whether it was the partnership originally or Berkshire now or Blue Chip Stamps when we owned it or even Diversified Redeemed, we wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital in. And if we failed at it, we really felt like we'd failed. It didn't make any difference how much money we made from fees or anything like that. We knew what our yardstick was. And so that will continue. I think Berkshire is better situated than it's ever been, except for the fact that size is a drag on performance.
If you're looking to earn a reliable monthly income of $1,000 from dividends of stocks or ETFs with a dividend yield ranging from 2 to 6%, this will allow you to reach an annual passive income of $12,000. However, it's important to note that you'll need over $200,000 in your bank account to achieve this. Although it may seem difficult, it is important to understand that compounding is the key to achieving success with passive income. Consistently investing in stocks that pay dividends and reinvesting those dividends is crucial. Let me illustrate with an example using Home Depot. In 2013, Home Depot's stock was priced at around $80 per share and paid a dividend of $1.56 per year, or 39 cents per quarter. If you invested $1,000 in 2013 to buy Home Depot shares, you could have purchased around 12 shares. At that time, you would have only earned $18.70 in dividends over the year, since each share cost only $80. Fast forward to the end of 2022, those 12 shares of Home Depot stock would have paid you $91.20 in dividends. This dividend income increase occurred because the dividend payments grew to $7.60 per share annually. Let's consider an alternative investment strategy for Home Depot stock. Instead of investing a one-time amount of $1,000, let's assume you invest $400 per month, allowing you to purchase around 5 shares of Home Depot every month in 2013. Over the past 10 years, this approach would have enabled you to acquire a total of 300 shares of Home Depot. I am sorry, but the number of shares you can acquire in 10 years may not necessarily be 600. As the share price rises, the number of shares you can purchase decreases. Therefore, we are using the average price to estimate the total shares you can obtain. In 2022, Home Depot paid its shareholders an annual dividend of $7.60 per share. This implies that owning the Home Depot stock you accumulated over time would earn a passive income of $2,280 via dividends in 2022. Suppose you invest $1,000 monthly, buying Home Depot shares each month since 2013. But here's an exciting twist. Instead of cashing out the dividend checks, let's assume you use that dividend money to buy even more shares of Home Depot. This way, you can purchase more shares yearly, generating even higher dividends. You can then use these higher dividends to buy even more shares and continue to build your Home Depot stock portfolio. By buying more shares and earning more dividends, you can create a cycle of passive income. For example, after 10 years, you will have 834 Home Depot shares, a nearly $6,340 annual dividend. Since then, even without investing additional money, Home Depot usually will pay you this amount yearly as long as nothing fundamentally changes. You can purchase an additional $6,340 worth of Home Depot stock annually by reinvesting your dividends. Your wealth will start to snowball, gaining momentum without investing more money. If you continue to buy stocks as usual and reinvest your dividends, you'll reach the $1,000 per month passive income milestone in 3 years, and it won't stop there. Your Home Depot stock portfolio will be worth around $500,000 by then. This strategy allows you to double your annual dividend income in less than 4 years. The best part is that your wealth will grow exponentially as your passive income increases. Every time you add more money, it's like adding more snow to a snowball, making it bigger and faster and accelerating wealth creation. Therefore, it's natural for people to strive for a competitive spirit in this game by purchasing more shares and trying to achieve financial freedom as soon as possible. If you want to grow your wealth faster, there are some things you can do. For example, investing in stocks with higher dividend yields and growth rates can greatly benefit you. Many companies offer 2 to 3 times higher dividend yields than Home Depot. However, to achieve success, you need 3 things. First, you need the right education and information to avoid poor decisions. Second, implementing compounding into your strategy is crucial. As Charlie Munger once said, the first rule of compounding is never to interrupt it unnecessarily. Consistency is essential to achieve impressive results. It's important to remember that investing is a long-term commitment and won't make you wealthy overnight. Think of it like a marathon, where you must stay consistent and steady to keep moving forward. Some believe investing is like winning the lottery, but that's false. It takes time and may take several years, but it's worth it. During this time, you'll put your money into assets that won't deplete your funds and may generate income. You'll increase your overall wealth and passive income by reinvesting your money into assets over the years. Patience and taking things slowly are important to maximize your returns. One way to expand your knowledge and improve your understanding of investing is to read books about it or subscribe to our channel. Another helpful approach is to follow the example of successful investors such as Warren Buffett.
We appreciate your watching. Please hit the like button below if this video helped you in any way and don't forget to subscribe to the channel. Thanks again and see you next time.